My name is Jake, welcome to the channel. In today's video, we're going to do a review my pie video where I review subscriber portfolios. This is one of my favorite series on the channel. I really enjoy how, seeing how different people view the topic of dividend investing. This is a little bit more of a laid back conversation. There's not a lot of editing that goes into these videos. I review different portfolios and share my thoughts and opinions with all of you. I try to make it applicable so that everyone can get a little bit out of it. I try to look at different time horizons and different goals and strategies so that it's applicable for a wider audience. I'm excited to share that this video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to analyze my dividend portfolio. You can check them out with the link in the description below and use promo code DGI to get the very best pricing. It's really been a rough year for dividend investors. Almost all dividend ETFs that I track have lagged the market this year. I think, looking at Q3, the September dividend payout for some of these ETFs, I think DGRO had a lower dividend payout of like 8%. VYM had a lower payout, and a few others had a lower Q3 dividend payout this year than last year. So I'm not talking about the whole year. I'm just comparing Q3 last year to this year. And I was holding my breath for SEHD this week. For part of me, I was thinking, what? I'm just going to assume that SEHD has a lower payout. That way I can't be disappointed. So I just set the bar so low. So it was really great to see that SEHD ended up raising its dividend about 3% from Q3 of last year to Q3 of this year. But yeah, 2025 has not been very great for dividend investors. When you're looking at the S&P 500 or the NASDAQ or any AI or unprofitable stock just going to the moon, I guess that's the phrase that we use now. I think it's like we're back in 2021, things are going to the moon. What happened after 2021, nobody really likes to talk about, especially when every day the market's basically green for the most part. But, I'm hopeful that dividend investing will come back into favor, as interest rates come down and, maybe some of the froth gets out of the market, people rediscover dividend investing or yield, here in 2026. And if that were the case for SHD to come back into favor next year, well, it could maybe look a little like this.
Yes! Yes!
جواش جواش
اسكت!
يلا two more chances.
والله لا افكر
اسكت!
حجره ورقه مقص
والله لا
هتيجي شغلك انا
آخر واحدة last chance. لا
My gosh. Oh man, it was the hop. It was the hop that did it for me. When he does the hop and he hits his head. Oh my gosh. All right. Okay. Back to it. Back to your regular programming. All right. So we're gonna do the review my pie. We're gonna take a look at a question. I'm not sure who the question is from. I got in one of my comments here on the channel, and then we're gonna take a look at 3 portfolios. The first from an 18-year-old, the second a 30-year-old, and then the third a 40-year-old. Here, all from the United States. As always, everybody, the timestamps will be in the description below, as well as the portfolio links as well. And as always, everybody, please do not take what I'm saying as financial advice. This is just merely for your entertainment. And really quick, I wanted to bring this up. I have been doing this for the last couple of years. In these Review My Pies, I'm addressing a broad audience. So I try to make it as applicable to as many people as I can. If you do want to book time with me and want to talk to me about your particular situation, you want to dive into the nitty gritty, the details of your plan, your goals of retirement, or living off your dividend portfolio, or you're struggling with something and you just want to talk to somebody, I offer this once a week where people can book time with me directly. It's all via Google Meet. I've been doing this for, I think, about 5 years or so. I try to make it as personal as I can. I'm not a financial advisor, so I can't give you professional financial advice. So I can't tell you what to buy and sell. But if you just want to have a conversation, you're struggling with your portfolio, I do offer this. I do this once a week. And I'd be very excited to meet you and hear about your story. And hopefully we can talk about it, and hopefully it can be of help to you. All right, let's take a look at the question here. So I got this question on one of my videos a couple of weeks ago, and I thought the question was so good and so applicable for so many people that I copied the question and I emailed it to myself so that I would remember to review it in this video. So the question was, and I can't remember exactly what we were talking about, something about retirement or something, but the comment here is from, I don't know who it's from. I didn't copy who it was from, but the comment was, or the question was, I don't know anything about cash secure puts. LOL. It must have been funny or something, I guess. I'm 31 years old and I have about 45,000 in a taxable account and about 108,000 in a Roth IRA. He doesn't have a 401k. He or she, I don't know, still trying to figure out what ETFs I should put all this into and just forget about it. So set it and forget it. I've been driving myself crazy with going between VOO. VOO is the S&P 500 ETF from Vanguard, or VTI. VTI is the total US stock market ETF from Vanguard. The way that you think about it, VOO is, the S&P. VTI is every publicly traded company in America. Or VT. Now VT is also from Vanguard. It covers every publicly traded company in the world. Or, the Boglehead approach, or dividend growth, or just growth, etc. I've read about all of these paths and still can't decide. Any advice on what you would do? So I love this question because this is just your average person who probably stumbled across a finance TikTok, YouTube short, or video, or their friend or their coworker is investing, and they're like, oh crap, I'm 31 years old and I'm late to the game, is probably what this person is thinking. Now, 31 years old, they're not late to the game. I didn't take my finances really serious until I was about 29, 30 years old. I didn't really have all the answers either. So 31 years old is a really good time period. And, I really like this question because it reminds me of me, right? 10 years ago, 15 years ago, I was lost. And I had all of these questions as well. And I want to help this person and anyone out there like this, how to think about this. First off, what I would say to this person or anyone in this situation is there's a lot of noise out there. Okay. There's a lot of commentary. There's a lot of different channels and blogs and articles swaying you in one direction or the other. Now, I'm not going to sit here and tell you that I have all the answers. What I'm going to hopefully try to do is help you to ask the right questions for yourself so that you can make this easier on you. Because when you go and you watch a video about investing or retirement or whatever, you're hearing that person's perspective with their own biases in place. I'm just going to try to help you to ask the right questions so you can figure this out for yourself. I'm trying to help you learn how to think about this and not what to think, because there's a fundamental difference between those two. So first off, I want to encourage you to really start with the basics and keep it simple. Focus on having a strong foundation of understanding of what you're trying to do here. There's a lot of questions in here, and I think really what it boils down to is direction. You don't have any direction, and that's okay because a lot of people don't. I didn't have direction when it came to this, when I first started out. So you really want to start with your why. Why are you investing? Why are you asking these questions, right? Are you thinking about your future? Maybe you have, a parent or a friend or a relative who's maybe, sick, or they're, struggling with things financially, and you don't want to be in that situation. So it's causing you to have these questions pop up that maybe you weren't thinking about before. So you want to start with asking the question, why? Why do I want to invest? Why should I invest? And what are your goals in life? Do you want to lead a regular life where you're working a 9 to 5 until you're 65? You clock in, clock out, have 2 weeks of vacation, and that's the end of it? There's nothing wrong with that, and there's nothing wrong with not having the answer to that question. That's really where you want to start, okay? You don't want to really go all in one direction until you figure out which direction you want to go in, okay? So it's really first starting with the question, why? And then once you have your why and your goal, then what you want to do, this is a trick that I learned, is you want to learn, and I figured this out by myself, kind of just working through this. After you have your why and your goal, work backwards. How do you reach that goal? If you were to think or fast forward 20 years, what do you want that to look like in 20 years? So take just a moment, close your eyes, and think about it for a second. Imagine yourself in 20, 30, 10, however many years, your why, your goal. Imagine for a second that you've reached your goal. What does that look like? And how did you get there? And then it comes down to putting, things into motion so that you can get to that place. You're lost because you don't know where you're going in life. And that's okay. I'm not trying to put you down, but that's the reality. So you want to figure out what you want and then go after it. So don't feel bad because most people don't have this figured out and they just push it off to worry about it later. Kudos to you for asking the question and to start thinking about your future now. So a couple of things that I would recommend. So after you've figured out your why or you're working on your why, then you want to ask the question, what do you want your future to look like? When do you want to enter into the next phase of your life of retirement? What is that going to look like? And then what you want to do is learn about compound interest and the rule of 72 and which investments grow faster than others. Why do people invest into growth? Why do people invest in high dividend stocks? They're growing at different rates, so you want to understand why. And this comes down to understanding how to invest based off of your investment time horizon, right? If you've never heard of that before, that's really, really important. And you got to make sure that you understand that. And I'll reference that here in just a moment. So the next thing that you want to do is you want to, based on your goals, pick an investment account like a Roth IRA, 401k that you want to focus on. If you know that you're going to retire after the age of 60, well, then it makes it pretty easy. Focus on your retirement accounts. If you think you're different and you want to live a different life and you want to retire in your late 40s, well, then maybe you need to have a different strategy. So really, once again, it starts with your why. What is your goal? And then you want to pick an investment approach that you understand and one that you can stick with for decades. Okay? Really, really important. I'm going to say that again because it's really important. Pick an investment approach of all the things you just talked about here in your comment, and one that you understand and that you can stick with for decades. And then once you've done all of that, you understand which direction you're going in, you understand where you're headed, then it comes down to the things that I always love to say on my channel. It's a little bit more common sense, but it's a good reminder. Stay out of consumer debt. Don't spend more than you make. And try to earn money over the course of your career at your day job, or try to build, a side gig or a side hustle, something that you can generate a little bit more income so that you can invest more into your account, so that you can invest more. You're not going to move the needle by, trying to pick a penny stock and have it go to the moon. It may work, but it probably won't. So you want to focus on what you can control. And then lastly, you do this for decades. And I can almost promise you that you'll retire a millionaire. Okay? If you're doing these things, you're sticking to the basics, and you're keeping it simple, I can almost promise anyone out there over the long term, over decades, you'll become a millionaire. Okay? Those are the things. It's not complicated. You just have to peel back the layers and understand each piece and not overcomplicate it. And depending on how many decades it may take you, $1 million may or may not be the same amount that it is today. Inflation is a thing, so you want to understand and really learn about how your money is going to grow and, take it step by step. Don't try to go for the home run from day one. Maybe you just want to get on first base, right? Maybe you just want to get a little hit. Don't try to swing for the fences when you're first starting out. Baseball reference. Apologize to all my European friends out there that don't understand baseball references, but don't try to go for that Hail Mary, that, getting a home run. Maybe just try to get on base to begin with, and then learn as you go. I have 2 videos that I would recommend. I'd recommend that you check out the video where I talk about, dividend, why I chose dividend investing versus the 4% rule, and the dividend growth pyramid. The dividend growth pyramid talks a little bit about, investing based off of your investment time horizon. I think both of these videos will help you and anyone in your situation. And the reason why I wanted to touch on this, I kind of mentioned this earlier, this question so thoroughly is if I could go back and talk to myself 10, 20 years ago, this is generally what I would have said, what I would have told my younger self. So it's not everything that you would need to know and learn, but it gives you a foundation that you can build upon. And also, I'll give you a side note, another tip, stick with ETFs. Don't buy any individual stocks unless you wanted to for fun. Put your real money into ETFs. And VOO or VTI or VT, me personally, I like VTI. I have a little bit of VXUS. It's a little international, but don't overstress it. If you had 90% in VTI and 10% in VXUS, you're completely fine. If you did 100% in VT, I think you're also going to be fine. Don't overstress it and figure out which approach works for you. I hope that this helps, and I appreciate you commenting on my videos. Whoever you are, I can't remember. I just copied the question here. So I hope that that's helpful. All right, let's take a look at the first portfolio here from Allan. He writes, "Hello, Mr. Jake. My name is Allan, and I started investing in dividend stocks since I turned 18 this past October and have a good idea of the stocks I'm choosing to invest in and hope to add an additional 8 to 18 more dividend stocks in order to broaden my exposure to the market and increase my overall yield, but just wanted to see if I'm set right where I'm going, which I should mention in retiring between the age of 35 and 45. And I just want to know if I should keep on doing what I'm doing or should I stop?" Well, this is, you're putting some big pressure on me. I'm trying, you're basing your future on my comments here. So let's see here. So you're 18 years old. Are you in college? Did you go to trade school? Did you start your own business? Do you work a day job? What are you doing, right? So where you're 18 years old, are you living with your parents? Are you out on your own? Do you have a car payment? Do you have student loans? A lot of things are hitting you when you're 18 years old. I remember when I was 18 years old, I was playing World of Warcraft and I was leveling my undead rogue in, I can't even remember where it was. I was worried about playing video games. I still play video games, but I wasn't thinking about this stuff at 18 years old. So the fact that you're even thinking about this, I think is really cool. So your goal is in the next 20-ish years to start living off of your dividend portfolio. I think 20 years is a really good time period. When you're mid 30s, early 40s, you're going to have, a lot's going to change from now until then. You might get married, you might have a family, you might have kids, you might have a lot of things change between now and then. So the best advice that I can give you and anyone in your situation is remain flexible. Don't think that you have everything figured out today, because I promise you, this is one thing that I can say with 100% surety, because I know this, you don't have everything figured out. You might think you do, but you don't. And that's okay. So the mere fact that you assume that you won't have everything figured out is you're already a step ahead, right? So just assume that things in your life are going to change. And so my main focus on this would be to remain flexible in how you're investing. The first thing you want to take a look at is where you're investing your money and what you're investing your money in. So where you're investing is which account type. Is this a Roth account? Is this a traditional brokerage? Because you plan on living off your portfolio before the age of 59 and a half, you probably want to focus on a taxable account so you can access the money before the age of 59 and a half. But I would highly encourage you, don't completely ignore retirement accounts like a Roth IRA, an HSA, an employer, match, right? So make sure you're having a plan when it comes to that. All right, Alan, let's take a look at your portfolio. So you got a handful of different stocks in here. You got 12 of them, and they're fairly equally weighted. Is that correct? Okay, it looks like it. Okay, so what is your overall portfolio yield? You got a 3% dividend yield. You have 0 ETFs in here. You have a mix of growth. You got a REIT in here, semiconductor. You got a few REITs. You got EPD. You got Procter and Gamble. So I think the majority of you who follow my channel, the very first thing, you already know what I'm going to say. And you did mention in your email that you're going to add more holdings. So the very first thing is risk management. If you're investing in individual stocks, I would not have more than 5% into any individual stock. In my opinion, the risk is just not worth it. If you want extra exposure into an individual stock, go buy an index fund that holds it. And so you can get more exposure that way. So that's my opinion. And I'm sure it annoys some people that I say this all the time, but it's one of those foundational things. It's the basics, right? You really got to stick to the basics. And for me, that is a simple basic. I like the companies that you have in here. Me personally, you got 3M in here. So one of the challenges with having individual stocks is you have to keep up on them. 3M did end up cutting their dividend about 50%. I talked about this here in my last week's video. But this is one of the risks when you have individual stocks is you will have dividend cutters there, eventually, right? So nothing goes up forever. You got 8% in Omega Healthcare, a REIT, you got FRT. I personally would probably drill this down to about 1% each or take them out entirely, me personally. And then you could always add them later. You don't have to have 8% in here today. You're going to have a lower dividend yield, but you don't need the income today. You're 18 years old. You said that you're not planning on living off your portfolio for like 20 years. So why do you need the income today? You're just going to be paying taxes on it. There's really no sense. And so this is a perfect example of understanding, the dividend growth pyramid and how to invest based off of your investment time horizon. So if you're investing into a portfolio like this, where you're having a lot of individual stocks, you can do that. That's fine if that's what you want to do. But I would focus more on dividend growers and less on a higher dividend because you don't need the dividend now, right? You would much prefer a growing dividend and a growing share price than, the reason why is, certain companies are great for wealth appreciation, wealth accumulation, and certain stocks are great for wealth preservation, right? Where you're preserving your wealth. You don't want to preserve your wealth if you don't have wealth. And it doesn't sound like you have wealth yet because you're at the early stages of your journey of trying to achieve financial independence, right? And that's normal. So you want to focus on companies and ETFs that have a higher growth rate. And that comes back to what I was talking about in the last one with the rule of 72, okay? So in my opinion, companies like Procter and Gamble, 3M, probably would just get rid of it personally, but EPD, Omega Healthcare, Procter and Gamble, I would put those at 1% at maximum. And then companies like Lowe's, PPG, or Taiwan Semi or Caterpillar, you could put those at a 5% and then add others. But if you really want to, juice this up and get it, Jake approved, you could look at the Simple Path to Wealth with Dividend Investing, which was inspired by Jill Collins that I talk about on my channel, where you focus on the core and satellite approach, where you have a core portfolio of ETFs, dividend ETFs like DGRO, SEHD, and you have satellite positions like these. So you're focusing more heavy on ETFs. And so, in your email, you asked my thoughts. A lot's going to change. And so in my opinion, what I would recommend, and if not knowing you at all or your situation, what I would recommend to any 18-year-old, what I would recommend is I'd have like 20% SEHD, I'd have like 30% DGRO, and I'd have 50% VTI or the S&P 500. I personally like VTI. That's what I would do. And if you wanted to have like a growth portfolio or individual stocks, you could trickle them in there, right? Maybe instead of having 50% S&P 500, maybe you have 40%. But this really aligns well to what I was saying in the beginning is flexibility. When you're 18, you want flexibility because your goals in life will change. Maybe when you're in your late 20s, early 30s, you want to buy a house. you don't want to sell your dividend stocks to buy a house, and you're not going to have money likely unless you get a small loan of $1 million. You're probably going to have to sell some of your assets. And it's best, in my opinion, to sell a growth ETF or, an S&P 500 fund, something like that. And that's why keeping it flexible, keeping it simple is the right approach for every 18-year-old. At least I'm giving you the recommendation that I wish I would have gotten when I was 18 years old and what I wish I would have done. So that gives you a lot of flexibility, and you can always change your mind. But the key word here is it keeps it flexible. But yeah, I hope that helps. It's a little bit of insight, into how I view this. Keep it simple. Focus on ETFs, if in my opinion, for most people, because you're going to end up changing your mind. A lot of these companies are going to end up cutting their dividends down the road, and that's fine. That's just normal. It's just how things work in life. Not everything goes up forever, but focus on keeping it simple and flexible. Thanks for sending over your portfolio. All right, let's take a look at the second portfolio from Curtis. He writes, "Hey Jake, first and foremost, just want to say I appreciate everything you do for the community and the insight you provide." Thank you, man. I really appreciate you saying that. "I'm 30 from the US, started investing on August 17th, 2020. That's like me with my diets. I know the date and time when I started a diet. I have to restart them quite a bit, but it's funny that you know the date. Do you know the time though? Do you know where you were? Because it can be pretty life-changing. My plan is to live off my dividends in the next 10 to 15 years. I have non-dividend stocks also that I'll transfer over to dividend stocks or ETFs once I'm closer to FIRE." That's great, man. That's really, really smart of you. "But if you can give me some insight on my portfolio, I'll appreciate that. P.S. My allocation percentage is off because I have those non-dividend stocks in my portfolio that's not shown in my dividend tracker." So you have other non-dividend paying stocks in here. Okay, so all right, let's take a look at it. All right, so looking at your portfolio here, so these percentages do not include your growth percentages, because you have other holdings. So I'm glad you said that, because I probably would have freaked out and tore out my hair and started screaming at you. Having 26.23% in Apple, or 23.22% in Microsoft, 10% in Starbucks. Oh man, this is like, if you didn't say that part, like if this was your portfolio, I would have called this like a complete abomination in terms of how I view it, right? Like this would be like very, no, like I hate it. Thanks, I hate it. Okay, so, I don't know what your other percentages are, so I don't know what the real percentages are of these, but let me tell you my thoughts and opinions here. So you got a small handful of stocks. Are you really going to retire off of just these companies alone? Everyone to each their own, but let me let you in, kind of into how I look at this. I'm 39 years old. I'm actually living off my portfolio. It would scare me half to death if this was all my portfolio was. If I was living off of the income from these small handful of companies, I would literally lose sleep at night. I would not be able to do it, and, when I first started down, my path of dividend investing and, my journey, path journey, whatever you want people call it nowadays, my quest, my quest for financial independence, I didn't really know what it would be like when I reached retirement, when I really quit my job or was no longer working, and the investments actually had to pay for my living expenses. And I didn't realize how conservative I would become because of that. If you go watch my old videos from 6 years ago, man, I was all over the place, right? I was much more, willing to take on risk. Now, I don't want to mess this up. And that's why I focus so much on ETFs, and I sleep well at night. I would not be able to sleep well at night if I had a portfolio like this. I wouldn't be able to do it. And that's why I created the Simple Path to Wealth with Dividend Investing, which was once again inspired by Jill Collins. I adapted what he says for me as a dividend investor, and it helps me. It helps me sleep well at night. And you can use the core and satellite where, you have a core portfolio of index funds, ETFs, that, you rely on for your income. And that's more, you have a better safety net there. And then if you want, you could have satellite positions with higher yield where you're reaching for yield, you take on a little bit more risk, but you're not risking the farm on just a handful of stocks, right? And you may not realize this or understand this until you actually live off your portfolio. Because right now, everything that you're doing is all theory based, right? Hypothetical. Once you pull the trigger and you actually, live off your portfolio, it's a whole nother beast, right? It's a whole nother experience. And you learn a lot about who you are as an investor and your risk tolerance. And I can just tell you from firsthand experience, it shocked me. I didn't see it coming, but I'm really grateful that I've adapted my strategy and I've tried to share it with others here on YouTube that, this is real life, right? How many people on YouTube are actually living off their dividend portfolio? I can think of 2 or 3. The rest are just talking theory. They don't know what it's like. And that's why they're so willing, and I was as well, into, I don't want to toot my own horn here. I did this, unfortunately, as well. I was naive to the reality that, taking so much risk is not something you want to do when you plan on living off your dividend portfolio. So that's a little bit of a rant from my end, but I do not like this. I don't like this approach. I don't. And so I wouldn't recommend this to anyone. And I think I would suggest, if you're serious about retiring off of your dividend portfolio, to maybe watch some of my other videos, get a little bit of a different perspective on how this could potentially look like, add some dividend ETFs in here, or add additional, dividend stocks, diversify a little bit more across different sectors. A portfolio like this, you could solve a lot of the issues that this portfolio has with SHD and DGRO. And then you add these in addition to SHD and DGRO. That's what I talk about, right? And you could easily, make this work or make this a little bit, it would make it easier in early retirement is all I'm saying. So I know that not everybody agrees with me, right? And that's fine. This is just merely my opinion. I'm talking into a microphone and it could just go into one ear and out the other. But this is just my personal experience and this is why I share it. But this approach, don't like it. I would suggest reviewing your strategy and seeing how you could de-risk this in most cases. So, and look at it, from that lens. But yeah, thank you so much for sending over your portfolio. I hope that this is helpful. It's maybe not what you wanted to hear, but it's my honest opinion. And that's hopefully what you were here for, is my honest opinion. And there you have it. All right, let's take a look at the last portfolio from Jim. He writes, "Hi, Jake. My name is Jim. I've been watching your channel for about 3 years." Man, you watched my channel for so long. Thank you so much. I appreciate it. I'm sure all the cringy memes and funny clips they're either hit or miss, I'm sure. But, and it's one of my favorite channels along with Ryan Williams and Investing Simplified. Yeah, I know Ryan Williams. I've been, he's been on YouTube for quite a while. One thing that I will give Ryan a comment. I don't chat with Ryan a lot. I don't go on, comment on a lot of his videos. But one thing that I will give him is, a lot of dividend investing YouTube channels almost always pivot to another topic. And it's possible that Ryan does this in the future. But one of the things that I like about Ryan is he's never sold out in the sense of gone and talked really about crypto or, other topics around dividend investing. Another channel that comes to mind is obviously PPC Ian, right? Ian Lopek, he's stuck with dividend investing through and through. I've tried to do that as well. I talk a little bit about options here and there, because I kind of get interested in it. I've never talked about crypto. I've always talked about either, mostly dividend investing. So what I've noticed is a lot of YouTube channels, they realize that dividend investing only content doesn't really go far on YouTube because it's such a niche audience. And so a lot of YouTubers pivot and talk about other things. And that's something that I really like about Ryan is, he's stuck with dividend investing, and that's something that I've noticed. And then you're right here. I am a 40-year-old nurse, and I work in the operating room at my hospital. I work around 70 hours per week, day and night. This amount of overtime and on-call hours adds up to nearly $200,000 per year, which is very good for a nurse. I'm debt-free, and I try to keep my living expenses to $2,500 per month, which includes rent, utilities, food, and discretionaries, I make a goal to put at least $15,000 into my 401k every year and invest it into a 2050 target date fund. I also have a Roth IRA that I max out at the beginning of each year. It consists of the following. Well, first off, Jim, before we get into your portfolio, I think it is absolutely incredible. You're working your butt off, right? You're working 70 hours a week. My mom, for my entire life when I was growing up, my mom was a respiratory therapist, worked nights, would work on Christmas, holidays, days, night shifts. I know how difficult it can be, especially if you have a family. So I think it's, you're putting in the work now so that you can hopefully retire, hopefully a little bit earlier than the traditional age of, 60, 65. Maybe you can get there maybe here in your 50s in the next 10 or 15 years. I don't think you don't mention your time frame. So I don't know, if you're planning on retiring before 59 or after 59, because then it's very clear if you're going to retire after the age of 59, well then, yeah, you want to max out your 401k and your Roth IRA, HSA, and then whatever's left over, then in a taxable. But if you're planning on, 40 is kind of an interesting time because you're close to that 59 and a half timeline, but you could also retire in your early 50s. So starting when you're 40 years old in your 40s, it's a little bit difficult. If you're in your 20s or 30s, it's a little bit easier because then you could focus a little bit more on your taxable account because you want to retire earlier. If you're in your 50s, it's obviously easier because you're probably going to retire after you're 60. So you're in kind of a little bit of you're in the middle there. So it could go either way. So let's take a look at this. You got your Roth IRA, 50% is in growth ETFs, SCHG, and VGT. You got 30% in DGRW, and you got 10% in international ETFs, SCHY and IGRO. Okay. And then you got 10% in Berkshire. So I like this, right? You're 50% in growth. You got some in dividend growth. You got some in international. You don't have any bonds. I actually really like this. It's very, very simple, very straightforward. Me personally, what I would probably do, I probably would swap out or lower DGRW and get something like VTI, the total US stock market, because you have a little bit more flexibility with that, I probably would do that. If this was me, I probably would keep the 50% in in the growth ETFs, and I probably do 15% VTI and 15% DGRO in this case, right? I like 10% international, 10% in Berkshire. It is a single company, but it acts like an ETF. So I'm not going to get too nitty gritty on that piece because I'm sure there's going to be people out there. Oh, you're not making the 5% comment on Berkshire. I am, and I'm not. I mean, Berkshire is kind of I probably still would only do 5%, but 10% is okay. All right. But I probably would do 5. But yeah, so I probably would look to add a little bit of VTI to get some broad, exposure to the US because, I like that, right? It's more broadly spread out. You get more exposure, you're getting every publicly traded company in America. And I like that. So you continue down here. I'm thinking of increasing the size of my 2 international positions to up to 20 to 30% and holding off buying more growth until after a major correction. Once my Roth is maxed out, everything else goes into these 3 buckets. So I guess with the 20 to 30%, I personally, as a US citizen, I don't think you need to do that. I personally only own 10% into international. I own 10% of my Roth in VXUS. And then I have 40% in VTI, 40% into VGT, which is a lot, and 10% into VNQ, a little bit of real estate. And that's how I do it personally. When you invest in the total US stock market or in big tech in America, by definition, you're getting international exposure. So, I think it's like a third of the S&P 500's revenue is generated outside of the United States. So when you look at it from that lens, I don't think you really have to, get 30% direct exposure to international, but that's just my opinion. So moving on here, once my Roth is maxed out, everything else goes into these three buckets. First is my taxable account, which holds three positions, 40% SEHD, 40% DGRO, and 20% Berkshire. Okay, so I like the 40-40 DGRO SEHD. I think 20% is quite a bit in Berkshire, but once again, it's like an ETF itself. So it's not as, I personally wouldn't do it. I probably would do 20% VTI personally, but if you want to do Berkshire, so be it. That's fine. Second, I'm saving up for a down payment on my first real estate investment property. Third, I have started buying gold and silver. So I try to put at least $1,000 per month into each of these buckets. I'm curious to know what your opinion is on gold. And then you have here, I would also like to know your opinion on the fact that I don't include broad US ETFs or the S&P 500 in my Roth or taxable. So I already kind of answered your question down here. Let me know what you think. Keep up the videos and may God bless you and your family. Nurse Jim. Well, Jim, thank you so much for sending over your portfolio here. And let's talk about some of your questions. So first off, what is my opinion on gold and silver? Well, I mean, I'd have to be an idiot to say anything bad against them now, right? Like, isn't gold like up like 30 or something % this year? Gold and the world's kind of changed a little bit this year. A lot of central banks across the world are dumping US bonds and buying gold. And so, you can see that. You can see the inflows in bonds. The price in gold has not gone up just because everybody thinks there's a recession around the corner, right? There's a fundamental reason something's going on, right? So a lot of central banks around the world are, backing away from the US. And, that's reality, right? The reality, I'm not going to go down that rabbit hole, but for whatever reason, I'll let you decide. This year, a lot of companies or a lot of countries around the world are saying, hey, we're not going to buy the US bonds, we're going to buy gold. And that's the case. Okay. And so gold has done very, very well. Me personally, I would only invest into gold for like doomsday kind of scenarios. I personally would only invest into gold if you got a bunker and you're a prepper, right? Like you got food storage, you think the world's going to end, right? So that's my opinion. Otherwise, in a doomsday situation, I don't want gold. I want, I want food. I want like clothing and food. And so I'd much rather have be a prepper in that sense. I'd rather have more jeans and t-shirts in my basement, instead of having a precious metal. But that's just my opinion. So yes, my personal opinion, that's my opinion. But now when it comes to, how it applies to other people, when it comes to proper diversification, I see no problem with having, a percentage of your portfolio allocated to gold and silver. Of course, why not? You could have a percentage into Bitcoin if that's what you're into. Completely fine. That's why I like the core and satellite. It allows for flexibility. You can have satellite positions in other things that make sense for you. If you're, hedging against the unknown, you can do that. That's absolutely fine. But me personally, I don't own any gold, any silver. I think I have little gold coins from my parents, from their parents, but keepsakes. But other than that, I don't own gold and silver. But yeah, so another thing here is, the broad-based US ETFs and S&P 500. We talked about that. Me personally, I would swap out Berkshire with VTI, broad-based US ETF, and I would include in your Roth IRA VTI. And the reason for that is you're getting broad exposure. You don't know what the market's going to do. The market does what the market does. And DGRW is only a small percentage of the market. And if you want to kind of cast a wider net, you're more likely better off with going with a broad-based US ETF like the S&P 500 or VTI, because most likely your goal is you're going to sell out of your growth and you're going to rebalance into, income, most likely. So that's why I like that. And so me personally, I would not have Berkshire. I would replace that with VTI, but that's just my opinion. There's nothing wrong with having Berkshire, but that's how I would do it. But yeah, thank you so much for sending over your portfolio, Jim. I hope that you're able to cut back on your hours, and so you don't have to work 70 hours a week. Hopefully you're able to reach your goal, and don't forget about the journey, right? You know, this whole process of trying to reach financial independence or, you know, investing for your future, you're going to wish I've heard this from other people. You would probably trade all of your money when you're 60 years old to go back to your 40s or to your 30s. Noodle on that for a second. Think about that for 1 second. People who are in their 70s would give all the money in the world to be able to go back and be 30 again, 20 again, 40 again. So when you think about that, it puts it into perspective. Don't forget to enjoy the journey and enjoy this, because money is just a means to an end. That's all it is. It's so that you can pay your rent, pay your mortgage, pay for your food. That's all it is. Enjoy your life. Enjoy what you do. Don't put those things off, you know, and that's what I would focus on. So I hope that this video was helpful. I tried to expand a little bit more and go off on a cuff here a little bit and, you know, talk a little bit more, you know, just expand on things with my own opinion. And I hope that this video was helpful, and I hope that you learned something new. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics, and thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe.
Subscribe.
Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.